Topic A tonight, as the Bernanke Fed changes the game from quantitative easing to quantitative neutrality. King dollar is rising, oil and commodities are getting pounded, and stocks are correcting. First up tonight, CNBC's Brian Shackman joins us now live with all the details. Good evening, Brian.
You know, Larry, today was a big day in the stock market. Triple-digit loss in the Dow, weakness all around as you see the board here from the Dow all the way down to the Russell 2000, which was down 1.75%. But a lot of people are going to point to the dollar first, as Larry referenced, whether it's Trichet's comments last week, more Greek debt concerns, the dollar has been on fire, or rather, the euro has gone cold. 2 weeks up 2.25%. The spillover effects translated into another commodity carnage. Oil firmly below $100 again. Gold back toward $1,500. Silver, which had been bouncing from historic losses last week, also took another hit. But I actually want to point out copper, which was down more than 3% today. Yeah, silver, gold, still up year to date, but not copper. You take a look at Freeport-McMoRan, which is down nearly 20% year to date. Copper is down 12.25%. Freeport lost 5.5% today. If copper is a proxy for global growth, this could be a harbinger of things to come. In terms of stocks, Cisco beat by 5 cents, solid revenue, margin expansion, but it turned tail. Take a look at this chart. Popped in the after hours and boom, down now nearly 3%. Why? Well, John Chambers in the conference call still sees weakness that margins are going to compress. People seem to be looking for a reason to sell this stock, down now 12+% for the year, actually 14.75. Quick check on a correction there. I also want to look at the big stock stories of the day. Disney lost nearly 5.5%. Mars might need moms, but Disney needs the movie Cars out tomorrow. Intel upped its dividend. J&J, a nice upgrade for Goldman, which held up. Obviously, Johnson up 1.25%, and it's about pharma and not necessarily a bounce back in consumer products. And finally, Macy's, great numbers, and they doubled their dividend, Larry, up nearly 8%. So the dollar's making the moves. It seems to come from there first.
All right, I like that very much. By the way, plunging gasoline prices, you reported, actually going to be pretty good for consumer stocks over time. Anyway, many thanks to Brian Shackman. Now, let's bring in our traders tonight to talk about this carnage, as Brian calls it. We have Lincoln Ellis, Managing Director at the Linn Group, and Lee Munson, Chief Investment Officer at Portfolio. Lincoln, let me begin with you. What does an investor do right now? We've had amazing volatility in the last 5-7 trading days. What's the right play? Start me off with an actionable investment recommendation.
Look, Larry, I think at this stage of the game, you're well advised to continue to be defensive here, perhaps even stepping to the sidelines. The market has been and continues to be a global growth story combined with a global liquidity. Thank you, Ben Bernanke. Well, the liquidity piece of that puzzle is going away. The global growth piece still very much intact, but it's not going to come from the developed economies. It's coming from the emerging markets. And while we see a little bit of the slow patch there, you're going to want to be actionable, but you're going to want to step aside at the moment.
Lee Munson, I need a buy or a sell right off the top because this has been very rough trade.
I'm a buyer. Last week I said before the dollar bounce that people should have some dry powder. We got a dollar bounce. It's on fire. Oil got killed last week. It got killed today. I'm buying oil. I love copper. And I think that this is not the time to be defensive. We got the bounce in the dollar that I was talking about early last week. So take advantage of it. This is not the time to wait and see how things are going. You know, I don't know if the dollar is going to continue moving up, but I'd be a buyer right here. This is your golden opportunity to make some money.
Lincoln Ellis, do you agree with what Lee has just said? And I want to get you guys to narrow down some more. Now, Lee was pretty good. It was pretty actionable. But, Link, I want to come back to you on this. What about the energy stocks, which are getting a tarring and a feathering?
Yeah, no, I think we would actually agree with Lee here. And as we said last week in our conversation, Larry, our real thesis is about productive assets. So absolutely, in the copper space, in the commodity space, drawdowns or big washes out like we've seen 2 times in the last 2 weeks, those are definitely buying opportunities. But we don't want to be chasing momentum stocks. We don't want to be chasing technology. We'd certainly want to stay away from the banking sector. But productive assets, that's really where you want to be.
Lee Munson, what about I think you said you are buying back copper. Did I hear you say that? Does that mean you're buying the commodity material stocks? That's a very brave call. You know, that's a very brave call in this environment, Lee Munson. You have volatility like no get out.
Listen, that is not, volatility is what gives you risk and what gives you return. If you really think the dollar has some sort of place it needs to go, all it needs to do is bounce. Now, I don't know if the dollar has a floor, but I do know one thing. QE2 is done, but as far as keeping rates low and spending money, I think it's going to cap how high this dollar is going to be. We have industrial production. Yes, we have inflation, but I think copper is necessary. What I wouldn't be doing is I wouldn't be buying gold or silver right now, because what are you going to do with gold? Make some jewelry? Maybe you can make a case for silver, but it's overpriced. You got to buy stuff that people can use. And if this economy is going to go any place, you're going to need to buy copper. Use the bounce in the dollar to get those positions.
I'm sorry, fellas. I got to cut it off because I've got some breaking news. I've got to throw the baton to my friend David Faber, who's got something out there in Las Vegas about SEC Stevie Cohen. Hello, David.
Hello, thank you very much, Larry. Yeah, we wanted to bring our viewers up to date as Stevie Cohen prepares to make some remarks and do a controlled interview, if you will. Of course, Stevie Cohen presides over SAC, the giant and extraordinarily successful hedge fund. He's about to make his remarks, and we have learned at least what a few of those remarks will focus on in terms of his approach to the market. Of course, one would also anticipate he'll get a question or two about Raj Rajaratnam and about the continued, at least, focus, it would seem, on SAC in some ways. But as for the market, we can tell you that Mr. Cohen is going to tell his interviewer that he is net neutral at this point on the U.S. stock market. That would essentially mean that SACs are running a very hedge book. They're not long or short in terms of their exposure, but net neutral. He is a bit concerned about U.S. growth, particularly after QE2 ends at the end of June, although he does say, or at least is going apparently to say, that he does see the second half of the year having fairly robust domestic U.S. growth. He likes particularly energy, and within energy, natural gas, and things of that nature. So we can give you some sense, at least in terms of SAC's approach to the market. Of course, the firm itself under the microscope in many ways, though no wrongdoing has been lodged at it whatsoever in any way, shape, or form. I should point out that Cohen's remarks are off the record, but given this day and age and the fact that every single person in there has a BlackBerry, one might imagine, of course, that everybody's going to be BlackBerrying, tweeting, emailing, and doing anything else that they might do about those coming remarks. We'll bring more to you as we get it. Kate Kelly will have a lot more on the web as well, but certainly did want to update our viewers, given he is a very influential market voice with a very large hedge fund and a lot of money behind him. Larry, back to you.
All right, David Faber, thank you very much. Now, folks, go back to the investment story. It's time for a Kudlow 101. This is all my humble opinion. But as we talked about, there's a lot of turmoil in commodity and stock markets. Last week, they both got slammed. This Monday and Tuesday, they rallied back. And, of course, today, they got slammed again. So the heart of this story, commodities, especially gold, silver, and oil, and the dollar. And the heart of that story is a significant shift coming in monetary policy. Quantitative easing is going to end next month, and quantitative neutrality will begin. It's a game changer by the Fed, and on a de facto basis, it represents a relative tightening. Traders and investors are fighting like cats and dogs over the meaning of the Fed's policy. They shouldn't be. The handwriting is on the wall. Bernanke's less accommodative stance, what I am calling quantitative neutrality, is bullish for the dollar and bearish for commodities. And by the way, it's leading to a stock market sector rotation for the major groups. Looks like it's away from energy and raw materials and toward more defensive plays like healthcare, utilities, and consumer staples. Now, strong profits provide a good backdrop for this change in Fed policy and the rotation shift in the stock market. Profits are going to cushion whatever stock corrections are out there. And let's face it, with a zero interest rate target and a negative real Fed funds rate, the Fed will still be historically accommodative. But my point is this: going from quantitative easing to quantitative neutrality is a less accommodative Fed. I think it puts a floor under the dollar and a ceiling over most commodities. And I think this change from the Fed is the main source of the volatility that we are now witnessing. So let's bring in our ace market strategist. Bob Froelich is chief investment strategist at The Hartford. Michael Farr is president of Farr Miller in Washington. All right, Dr. Bob, let me begin with you. You heard my piece with all due humility. I see this as a game changer from the Fed with a big stock market impact. What is your response, my friend?
Well, I want to be bullish the dollar, Larry, because I do believe that, like you said, once quantitative easing is behind us, that the dollar is going to rally in that. But I see the dollar having an artificial lid because I see no progress on the budget deficit. And so to me, as long as that budget deficit is hanging over us, I think we're going to have a weak dollar. And so what I want to do is position my portfolio to benefit from that. So I still want to be long commodities, and I want to be long those industries that are going to benefit from the weak dollar, that derive a majority of their revenues outside the United States from foreign earnings.
Michael Farr, do we have a disagreement here? What's your take on my take and Dr. Bob's opposite take?
Look, I'm just wondering why it's taken you so long to come around to my point of view, Larry. I've been preaching this for the last 30 days. Come on.
Well, I've been there. Actually, I've been blogging there, but I wanted to go more formal tonight.
More formal, and I love it. You know, I don't understand how you can be particularly bullish here. Yes, there's been some still short-term momentum, and yes, we've seen sort of this push and pull on the risk trade. But when you've got China tightening policy and tightening reserve requirements at banks. Got the same thing happening also, Larry, in Europe with Trichet had been tightening rates. We've seen Europe and the EU tighten and weakness there. And not only are we seeing quantitative easing end, we're seeing a downgrade in U.S. debt. And in the face of that, the 10-year rallies. What the markets are telling you is they are forecasting, I think, a difficult economic period to come, and those defensive stocks make sense, and the rotation into them makes absolute sense.
All right, so we're pretty much in agreement. Quantitative neutrality is the term that I am coining, Dr. Bob. You know I love to coin terms, and I want to pick up where Michael Farr left off, because I'm sniffing out a big rotation. I mean, look at the charts. The healthcare stocks, the utilities, the consumer staples, they've been doing great. Energy has not, materials, commodities have not, and I want to ask you, are you ready for a sector rotation, and if so, where? I need specifics here.
Yeah, I am, Larry, because as I said, I do not believe that the dollar can rally. I think there's a difference between euro weakness and dollar strength. So fundamentally, this dollar is not getting stronger. So I look at the S&P and say, show me the money that's made outside the U.S. That's a screaming buy for technology. They derive a majority of their revenue outside the United States. I think that's very bullish for materials, for industrials, and I would throw consumer staples along there. I think it's a losing bet long term until Washington can do something with the budget deficit. I think the dollar looks strong because the euro looks so weak. I want to be in this market outside the U.S.
All right, Michael Farr, is Dr. Bob looking for love in all the wrong places?
You know, Dr. Bob's a very bright guy, and he's a buddy of mine, but he's looking for love in some of the right places, but he ought to visit a few new bars every so often. And I would add to his list the healthcare bars as well. I certainly agree with the technology bars and the consumer staples. I would stay away from those financial and banking bars for a while, with very few exceptions.
Why are banks doing so badly, Michael? I mean, they've really done badly.
Well, they don't have any loan growth, Larry. They really don't have any earnings growth. The only real improvements they've seen have sort of been lowering those loan write-offs and those reserves and bringing money back in. So they're not growing, and it's a very tough environment, and they're really not making any new loans. They ought to be with this sort of a yield curve, but they're not doing it.
I got to leave it there, gentlemen. Thank you very much. The term is quantitative neutrality. That is the new restaurant in town. Bob Froelich, thank you. Michael Farr, as always.